Yeah, I'm here, Brian. Are you wrapped up?
Yeah, that's about all I have, and I think that's all the questions. So, thank you so much.
Okay. Great. Thank you for your time. And we're going to bring in uh, Jason Jankowski now. And Jason, are you listening in?
Okay, I think I just turned my mic on. I just wanted to make sure we're on air okay.
Yes,
You
sir,
there?
you are. And I'm going to,
Good.
yes, sir, I'm here. And bringing up your PowerPoint now, Jason. And here we go. The room is all yours. I'll get the timer started.
Okay, guys, I guess I'm ready to go, right? We're all good? Okay. Well, first of all, thanks for having me. And this is my second or maybe my third opportunity to present to this group. And this is a rather challenging topic for me to do in 20 minutes. I hope I can really help you guys with something that will challenge your paradigm of thought about how the markets are structured and how to exploit price change. I'm ready to get right to work. You want to put a question in, I'm sure the guys will help with watching the bottom of the chat window for me. Let's get right to work. Always want to mention this because I never know who's listening, that trading in foreign exchange, futures or options is considered a risk investment. It's not suitable for all investors at all points in time. And so you want to carefully consider if trading is right for you in light of your personal tolerance for risk and your personal finances. People can and do lose money. In rare cases, they might lose more than they invest. Everything that we talk about in here is considered opinion, so it's subject to change at any time. And I want to get right to work. Now, I want to just ask you to indulge me for 2 minutes. Some of you guys are regular listeners. I was scrolling through the attendees and I saw all the names I'm familiar with, and of course some new people. If this is the first time you've ever heard me speak, I just want to take just 60 seconds and tell you I started in this business as a customer just like you. I'm self-taught, self-educated, and I'm a net winning trader today. I did my first trade in Chicago Board of Trade, big board corn, and I've traded in futures, forex, and options ever since then. I love this business so much I became a Series 3 registered representative, and I stayed in that industry until about 1995. And now I trade just for myself, my own accounts, and a very select group of private accounts. And also I have complete details on the education, training, mentoring that I do, as well as my brand new mirror trading program, which you guys that are trading Forex right now would absolutely love if you got to know it and understand it. So maybe we'll get a chance to do that at some point later. But I wanted to ask you, I've got 3 books published by Wiley. Anybody out there read these books? Time Compression Trading, my latest books came out here about 2 years ago. Art of the Trade, Trading Rules at Work. Anybody had any of these books or read any of these? Okay, a couple of yeses coming in. Okay, if this is the first time that you're listening to me or you've read any of my books, the most important thing I can tell you is that I believe psychology is the single most important part of winning consistently. I'm not saying that there isn't a place for technical analysis or fundamental analysis. It's just that in my opinion, I think most people greatly overestimate their true value, and they really don't know how to apply the proper relationship between market price action analysis and their own personal psychology. So I want to take now, and like I said, I'm going to take, and the reason I tell you that is because I need you to understand where I came from is exactly the path that you're on right now. The path that you're on right now, regardless of where you're at in terms of profits or losses, I've been on that path, and now I know how to win. And I can tell you what happened to me. That's actually The Art of the Trade is this book that describes the epiphany of understanding I had. But I can tell you what happened to me. If that has to happen to you to win, then you want it to happen tomorrow morning. If you don't know how to make money in this business consistently, it's most likely because you're missing a part of understanding, and that's what I'm going to try to cover with you. Now, I don't know if I can do a very good job of this in 20 minutes. I don't know if I can give you, a lifetime worth of understanding in 20 minutes, but I am definitely going to try. Um, Anybody out there ever heard of the concept of zero-sum transaction? I want to introduce zero-sum transactions to you. Anybody out there unfamiliar with it? A couple of yeses coming in. One guy says no. A couple of no's coming in. Okay, One of you guys that answered no, how long have you been trading Forex futures or option? One of the guys that answered no was BJ. BJ, I'd like to ask you, how long have you been trading Forex futures or options? Reed says never. Okay, well, I don't know why you're here. If I imagine you're trading stocks then, you got to think of stocks as musical chairs, whereas futures, options, and Forex, which are zero-sum markets, that's a tug of war. And we can talk a little bit more about that. Anybody else never heard the term zero-sum, maybe has been trading in these markets? If you haven't, here's what it means. It means Forex, futures, and options are all zero-sum markets. That means there's a buyer for every seller. Now, we did have a couple of yeses come in. They understand that. Now, most traders have heard this term. They understand, oh, yeah, it's a zero-sum market. And they have a vague understanding of what it means. It seems like an innocuous statement. For every buyer, there's a seller. But there is a huge, huge issue with that if you're not prepared to fully address it, you're never going to make a dime doing this. That's my astute, august opinion. As far as pursuing profits are concerned, understanding the psychology of what happens in a zero-sum market as prices move is vital. You're never going to get to the point where you make consistent money all the time until you can understand and exploit how traders approach zero-sum markets. Okay, here's what it means for a buyer for every seller. Here's what that means. For a buyer for every seller means orders coming into the market are being matched against each other from each other's opposite side. Now that means if I want to buy the market, I can't do that unless there's a sell order that comes in at that exact moment to match me with. All right, a buy order has to be matched with a sell order. Okay? So my question to you is, who placed those orders? If I want to buy the market, why would somebody else want to sell it? Now, if you understand zero-sum transactions, what that basically means is if I buy the market and you sell it to me, only one of us is going to make money from that transaction. The market's going to move later, and one's going to win, one's going to lose, and the important issue is, guess what? The winner gets paid from the account of the loser. If you've been trading in Forex futures or options, and your account is lower than when you started, some other trader in that market has your money. That's where the money went. You, the loser, paid the winner. That is a huge, huge difference between zero-sum markets and every other kind of investment. And if you're going to look for price change in the market, there's a couple of things that you need to understand. You have to understand and accept order flow. You have to you just have to deal with this. Some people don't want to believe this because they have their own psychological issues, but for every winner in the market, there's somebody losing. So if you want to win, you're going to have to beat somebody up and take their money. That's the bottom line. If you're not prepared for that emotional involvement, you can't do this. And you must allow order flow to develop. Understanding order flow is going to give you the real confidence to buy or sell a turning point. This is very important that you understand this. Order flow means orders coming into the market. Well, other traders determine if you have a profit, not you. That's what that really means. You can do all the analysis and you can do all of the charting that you want and come to a conclusion to buy or sell. But the fact of the matter is, it's another trader, somebody else that you don't even know, is going to determine whether or not you make money. Because once you execute into the market, once your order is offset by somebody else, there must be some other larger group of traders that's going to also enter orders and on the same side, so that there becomes an order flow imbalance. So in order for you to profit, other traders have to position themselves the same way or take losses by using the same side of order flow. In other words, if the market is at an important point to buy and you buy it, you're anticipating that a whole lot of shorts are going to cover or a whole lot of new longs are going to come in at the same time. If that isn't what's happening, if that's not the result of your analysis, then you have virtually no chance of winning except by luck. So you want to anticipate when the losers will liquidate taking their loss, because price action is always the loser liquidating. So you have to understand what those traders have a potential to do in order to correctly anticipate where and when a change in the order flow will happen. If you're the last guy to sell a market because you believe the, quote, breakout to the downside was a chance to get short, and you did that, if you're the last guy to do that, the order flow will go bid as the shorts cover and new longs take advantage of that lower price. Because at some point, that's going to happen. It's not an if, it's a when. There's going to be a point in time when the shorts cover or the longs liquidate, whatever price action you're paying attention to, that's going to change. There will be a change in the order flow. It'll be when the loser decides to quit and take their loss. And when that happens, most likely, the market will reverse at that point. Oops, I hit this button, sorry. Okay, now I want you to follow me on this. This is the basic underlying process that you have to exploit that relationship. The winner is going to come into the market and take a position. The eventual guy that's going to lose is going to be on the other side of those orders. When those orders become an imbalanced state, only one side's going to win. The loser will then pay the winner. So here's the thing that you have to understand about the basic underlying psychology is this. How do two people with access to the same information come to equal yet opposite conclusions? See, everyone has access to the same information. My price chart of euro on my desk looks identical to yours. There's nothing new or unique between one chart or the other. Every indicator is going to look the same. Every oscillator, every study is all going to be the same. Bollinger Bands on my chart is going to look identical to yours. There's nothing new. It's all the same thing. So if everyone is looking at the same information all the time, then how do two traders come to equal yet opposite conclusions? How does one guy say, all of this stuff that's on my chart boils around inside my head and says it's time to buy, and the same information in front of another trader says it's time to sell? So those two people come to that conclusion, they execute in the market, and now it's not physically possible for both to be right because the order flow from the loser taking his loss is going to drive that market in one direction or the other. And the only way that you're going to be able to know enough of what's possible in advance is if you stop thinking like the loser. In order for the market to move in price, the orders must be larger on one side or the other, and those orders are always from the losers trading that are liquidating. It's always the case. The smallest amount of orders being placed are the winners, or the smallest amount of people, I should say, placing trades are the winners. The largest group of traders in this business, 80 to 90% of people who execute in futures, options, or foreign exchange, have a net loss on their account between 4 to 6 months. They close out at a permanent loss. In other words, that's not my opinion, right? That's if you read any of the books on markets or you study any of the detail that you can get from some of the regulators about who the buyer and seller is in the market, et cetera. If you look at all that data, here's what you're going to find out. Typical account lasts 4 to 6 months. It's closed at a loss of more than 50%. So where did that money go? 80 to 90% of them. The only way you're ever going to be able to make any money doing this is you have to be able to buy weakness and sell strength. If you can't buy weakness, and in other words, when the market is dropping and it looks like it's going to go to zero, you have to step up and buy. If the market is rallying and it looks like it's going right to the moon, Alice, you have to step up and sell. Now, I'm not saying that because the market is breaking or because the market is rallying, you buy or sell. I'm saying you need to be prepared for the inevitable issue that you have to sell the rally and you have to buy the break. If you can't do that, you can't trade. And the reason you can't trade, and you will never make any money in this business, in my opinion, is because you can't get positioned against the loser by thinking exactly like the loser thinks. Because the loser is going to trade only one way. You have to be prepared to take advantage of the late participant. In my opinion, you have to exploit liquidation. And this is not easy to do for someone who's not thinking along a new line. But if you look at your account balance, look at all the mistakes and problems and complaints you have, and it's all based on when you liquidated. Did I wait too long? Did I not wait long enough? Did I get out before? Did I cut my profit short? Did I hold a loser too long? Your liquidation determines your account balance. It's not your initiation. That's part of the problem that the typical trader in this business has, is they think they're trying to figure out how to buy or sell the market perfectly. And so what do? They wait for confirmation, which I'm going to talk about in just a minute. So they're emotionally unprepared for the fact that it's not about a perfect entry. It's about a perfect exit. So since they don't control their liquidation, all of their relationship to the market is based on the prices as they move, their emotional bias is wrong. It's fixated on the liquidating price. It's fixated on the distance between the liquidating price and the initiating price, and they think the initiating price is the key to profit. It's not. It's the liquidating price. So you want to think about how you come to your conclusion and ask yourself, who else is thinking this way? You have to do something different than the loser in order to take his money, and that process begins with thinking better yourself and aligning yourself with the potential in the order flow, not what conventional knowledge or analysis says. If you could analyze your way to market profits, the richest people in this business would be technicians and chart people. And like Marty Zweig says, I've never met a rich technician. They don't exist. Technical analysis, I've done study after study on this, and I do all kinds of broadcasts on this, and I make all kinds of enemies when I say this. Technical analysis is no more predictive about market price action than chance. You will never be able to study a market and predict it using technical analysis. That's the incorrect way to use it. The correct way to use technical analysis is to understand that every other loser out there is using it, and they believe it's going to help them make money. So when you see a chart set up that says, wow, this is a major buy, there's generally a relationship to that market that there's one more leg lower coming before the buy, because everybody's seeing the same thing. They're going to buy, they're going to lose, that's going to be the bottom. Now they're going to wait for confirmation, and that's why they lose the second time. You want to look for clues in the developing order flow, not at the prices. I did a broadcast not too long ago, maybe some of you guys were there, about the relationship between market structure. Price is a fruit that comes from all the other events happening in the market. And that if you think about price as being the important issue, you'll make a mistake with regards to understanding how the order flow develops. For example, I'm going to give you an example. If a bearish piece of news came out, like earlier this week, for those of you trading Euro, Moody's downgraded France's AAA credit rating to AA1, I think, right? Downgrade. Euro broke 40 points, and within 12 hours, it's a new high for the week. That was a head fake. What happened there? That means the order flow is not for the seller. The order flow is buyer. Every sell-off is being bought. So until that emotional relationship to the market changes, every dip is going to behave that way. So until the market gets to some price where the buyer says, okay, I'm worried about that, it's too high for me, I'm going to take my money off the table, until that happens, dips are going to be bought in Euro. Now you get every other person out there arguing what that means. Well, it means this, it means that. Well, that's not true because, and they place themselves according to all of that rationalization, justification, illusion, misconception, whatever it is, and they put themselves at risk for all the wrong reasons, none of which have anything to do with the order flow in the market. If you look at the market and clearly observe what's happening, you will have to come to the conclusion that the buyers are outnumbering the sellers. Why? Because the price is higher. So that must mean order flow is larger on the buy side. Until that changes, the market cannot come down. It doesn't matter what your analysis tells you or even what the fundamentals are. Because we saw a bearish fundamental couldn't push the market lower. There weren't enough sellers. Does that make sense? Now, it might take time for the order flow to develop, but you have a good clue that the spike lower, that little spike that happened, is a buy to a large enough group of someone's, and that the prevailing thinking of lower prices is not correct anymore. It's just a quick example. Always remember, the price doesn't matter. What matters is who is buying or selling. Support is not any particular price. It's an area. It's a belief structure that exists at a price area that encourages enough people to place orders on the buy side. That can be shorts covering with a profit, shorts covering with a loss that were too late, or new longs. It doesn't matter. As long as that belief remains, the price won't go lower because there will always be enough people to buy around that area. The spike lower will always be seen by losing traders as the downside breakout. That's why they short it, because they're looking for confirmation. I'm going to talk about that in a minute. So the important issue here is that it might scare the heck out of you, but your best buy point is the next probe into that spike in the event that that happens again. And you want to avoid confirmation. And this is why, and this is my opinion. You know, I'm not trying to pee off on anybody else out there that might be listening. But in my opinion, this is why most people are losing in these markets, in foreign exchange, futures, and options. Here's why they're losing. They wait for confirmation. Whatever that means to them, they're waiting for that. Every losing trader is thinking about reducing risk, and they make the erroneous conclusion that reducing risk means waiting for the market to move. Confirmation has nothing to do with the order flow. It's completely to do with the trader's personal need emotionally for something. So when the order flow has potential to change, why would you wait? All you do is give up potential. If the order flow, the market drops to some price that immediately attracts buying, why wouldn't you buy there? That's the lowest risk, highest profit opportunity for what may ever be coming next, for whatever time frame the market has order flow to the buy side. If you wait for confirmation, what are you doing? You're giving up price potential and increasing risk. Why would you want to do that? The best clue that you have tapped into a large potential in the order flow is an open trade gain. So my opinion is run a break-even stop and wait. Wait for that order flow to develop. It's going to take time. If you look at any price chart, and for those of you that have read time compression trading, you can read in there clearly how the smartest, most well-capitalized, and highest-paid people in this industry, they're not day trading. They put a position on, and they're going to wait weeks or months for that to hatch. There's a reason for that, because they know it takes that long for the market to attract the right side of order flow, drive the price, and force the losers to the sideline with losses. See, this game is not about understanding market fundamentals or technicals in the same way as you might believe. It's about beating up the loser and taking his money. People know that are net winners know it takes time for that to happen. So you have to let the order flow develop. So when you have tapped into an area of price that is attracting one side or the other in size, you want to let that work. If the market returns to the starting point for whatever reason, so what? You have no gain or loss on that one. Look for the next one. As long as the market doesn't probe below a certain area, the probability is high that the order flow is going to go bid. The same is true for the top side. When you see a market reach, there's a real good potential the order flow is going to go offer. It takes time for that to develop. It can take weeks. That doesn't mean that every 50 or 60 points you couldn't trade it. It's just that the real money is made by getting in position and waiting. So that needs to be something you consider. And it's important to understand why that's the nature of how you win is by waiting, is because the losers can't stay in the market forever. It doesn't matter which side you're on. If you're on the winning side or the losing side, at some point you have to liquidate. You can't stay in forever. So if you're on the wrong side and the market is moving against you, at some point you must cover. That's going to create the largest group of imbalance in the order flow, is the loser being forced to the sidelines. If you're on the right side and that trade is now an open trade gain, why would you do anything? Just sit and wait. There's nothing to do, in my view, right? Okay, so quickly to summarize here, again, this is a very quick look at the psychology of zero-sum markets, and I hope this is challenging some of your existing thinking. But I want to just mention this to you, is that zero-sum markets behave the way they do because people will come to opposing conclusions endlessly, and they're never going to stop doing that. I can look at the same information that you're going to look at, come to two completely different conclusions, and we're fighting it out in the market for each other's money. Most of those traders that come to those opposing conclusions, they're late to the trade because they're all waiting for some sort of confirmation. No matter how you slice it, they're waiting for confirmation. The loser quitting drives the order flow. You need to look for the clues that the loser is in. Did the guy make his move? Not study prices. See, no matter how you want to agree or disagree with me at this point, you're not going to make any money at this unless you take it from another trader. You can't do that if you're using the same methods the other trader is using. You're just thinking the same way as he is. That's why you're losing. Does that make sense? So loser liquidation drives the order flow. Don't be that guy. Learn to understand that the market has potential within it to disclose what's most likely given a set of circumstances or conditions, and the order flow in the market tells you very clearly. My example earlier about how earlier last week, late last week, or earlier a few days ago, that Moody's downgraded the sovereign debt of France. That should be very euro negative. Well, the euro sold off 30 or 40 points and bounced right back. Well, that's a clue that the order flow is buyer. It's accumulating. It's not selling. Sellers don't have the advantage. So as long as people are willing to sell each new high, get a little bit of a dip, and then followed by a new high, the sellers are going to keep taking losses. As long as that happens, the buyers under the market, or those who are going long, will continue to win. And I'd be happy to show you a price chart of what I see there if that's important. I don't know if we have time to do that. I don't know if you can see this, but here's my contact information. I'd like to open the floor up to some Q&A if you guys have got the time. I mean, again, it's very challenging for me to put, lifetime of experience into just 20 minutes. I hope I've done an okay job for you. But I want to challenge you to think outside the box. Trading is not about what price is coming next. Trading is about how do I figure out what the loser is doing and take the other side against him, because that's where the money is. Because he's got to pay you to get out. When he liquidates his losing trade, he's got to pay someone. In order for you to win consistently, you have to do something different than that guy. So both of you, if you're both approaching your actions, you need to, but from the same thinking, you need to understand what that psychology is so you can get on the other side of it. And I can give you big help on all that. Here's my contact information. I'm still the only guy in this business that answers his own phone. You can follow me on Skype, Twitter, YouTube. Here's my website. I would encourage you to go to my website and sign up for my weekly performance broadcasts, or if you can't come to that, you can always you can always listen to the recordings. Every Friday afternoon, I put out there the trading that I did for the week. And I show you exactly the trades that I did, why I did them, gains and losses. Almost every week is a winning week. I have losing weeks, but usually I make all that back plus more the next week. And you're welcome to come every week and see exactly how I trade. And then we can do a couple of things. If you want to learn how to do that, then I can take you on as a client for coaching or mentoring. If you want to own the proprietary method that I use, I'll be able to help you with that. Of course, if you want to become a client that follows my trades in his own account through a mirror trading program, which we have for Forex right now, then you would absolutely love that. That's probably the smartest way to do it. But I'll be more than happy to take any comments or questions, and we can take all the time you want offline, off air. But I've got a couple of questions here real quick. Let me see if I got these right here. Let's see. Fitzroy says this. I don't know if this is right. He says, oh, wait a minute. This thing's moving too fast now. In number terms, a large number of uneducated traders are trading against a few successful traders. Well, you have to understand that almost everybody, you can make money in this business by accident and confuse that with having a true skill. So there's plenty of people out there that'll make money for a quite long period of time, a year or two, only because they're on the right side of something that's trending and they're smart enough to follow that trend. That doesn't mean they know what they're doing. So uneducated doesn't mean you won't make money. There's a lot of people out there that make money on a regular basis, have no idea what they're doing. You can make money by accident in this business. What I'm talking about are people that consistently, week after week after week, no matter what the market does, all the time, they're pulling money out. Those people are not thinking about what's happening in the market the same way the other guy is. That's why they win. So you can be educated or you could be uneducated. It doesn't matter. You'll still have the opportunity to make or lose money. And some of the brightest guys in this field that make the most money don't have high school educations. So what is it that really you mean by educated? In order to win, you got to be educated about the rules of the game you're playing. If you get smart and you realize the rules of the game are different than I was told, and that's why I'm losing, and you get the right rules, you're educated. It doesn't matter if you've only been trading for 6 weeks at that point. So I would be careful how I use that vernacular, me. You know what I'm saying? Me personally. Harat wants to know, does this apply to day trading? It applies to any trading you're going to do. If you're going to trade Forex, futures, or options, you're in a zero-sum environment. That means your only way to profit is to take that money from another trader. So when he enters the market and you enter the market, you have to be thinking differently. The only way you can do that is you have to be able to sell strength and buy weakness. If you can't do that, if you're too afraid to do that, which is why people wait for confirmation, you got to figure out what you're missing and fix it, because you can't make money any other way. Let's see. Doug says, so as I see it, you're always a buyer below the average price and always a seller above the average. Well, actually, that would be considered a very basic approach that I think you could learn to exploit. I wouldn't necessarily make it that simple, but you are on the right track. If the market is trending higher and you get a sell-off below the averages, that's probably in the buy zone, right? That would be a good way to put it. I wouldn't say that the average is the only thing to watch, but I would say that you're thinking in the right direction, Doug. And again, I'd be more than happy to have a conversation with you about that offline. Here's my email address. I just noticed I got the beep in my ear that says we're done. I don't know how well I did for you guys, but it's my hope that I hope I opened your thinking up to the psychology of zero-sum markets as being a little bit different. The reason they trade the way they do is a little bit different because the average guy participating is fueling the move that pays the winner, and they don't even know that for the most part. So it's my hope that maybe we've encouraged you to think a little differently, think outside the box, and I want you to keep my contact information down there. Consider me a friend in the business, and if we can open that dialogue at some point, I would welcome that. I don't see any more questions coming in, so Chuck, it's up to you. Do you want to take a few more? Are we done for the day? In any case, I want to say thanks for having me.
I think that's going to wrap everything up, Jason. And certainly thank you for coming in.
Sure.
And Jason's information is up here on the slide. Tell you what I'm going to do. I'm going to leave that slide up there. So if you want to copy it, you can click over to the slideshow tab. But let's go over to desktop sharing now, and we're going to bring Paul back in. Paul, how's your microphone working?
Hello, Chuck.
Okay.
I think it should be working fine. Can you hear me?
Yeah, I can hear you. So let's go ahead and try and start that desktop projection, see if we
No
get
problem.
better results this time around.
Okay. It is loading. We'll